I think there's some way to go yet. Obviously, these rate rises do have a lag effect. We should wait for another 6 months really for them to really take effect. But you've seen numbers come through from US bank accounts, cash on deposit. Americans are slowly whittling down the numbers they had on deposits since the pandemic. Of course, during 2020, you had those stimulus checks in the US as well. A lot of people had huge savings, the highest rate, I think, in history, or certainly close to it. Now that is falling quite considerably. So data like that is quite useful for the Fed as well. And it's interesting you mentioned that we're so jumpy now on all data. I guess the Federal Reserve doesn't help with that. They've remarked several times recently that they're much more cognizant of data. They're data dependent going forward when looking at future rate policy. And if they're saying that, I guess as an investor, you have to be as well, which I guess kind of leads to that kind of jumpiness.
Because it does make you wonder whether the market needs to see a recession here to actually cool off some of the jobs numbers, or whether simply the same more of what we've had now will simply bite for consumers, but we won't get a recession. It does feel very Goldilocks. I mean, JP Morgan increased their GDP forecast, so it suggests that we're going to have tightening for consumer belts here. We're going to have tightening for the corporate belt as well, because those refinancing costs are going up, but we're not going to have a recession. We're still going to have very decent US growth. Is that Goldilocks scenario really feasible?
If we look at historical data, then sadly no. The last recessions, the last rate hike cycles, it's been very rare that the Federal Reserve will achieve a soft landing. But I guess you can't rule it out at the moment. Like you say, it's sort of a Goldilocks scenario. Rates are going up. The US market, the US labour market in particular, remains very strong. Consumer spending remains strong. It's just a case of how long I think the Federal Reserve will keep rates high and try to really get inflation back down to 2%. It'll all sort of come into place, I imagine, by Q2, Q3 next year.
Let's just get some investment ideas from you too on the back of what we've been discussing, because it's been noted that there was some moves that we saw in July when effectively stocks peaked, and you had about 14 days in a row, this according to the Wall Street Journal, where the S&P and the 10-year Treasury yields moved in opposite directions. Typically, this was something markets looked for, to have some sort of portfolio protection. The bulk of what we've seen, though, over the last 21 years is that they've been moving in the same pattern, the same direction, which is not very helpful. What happens from here in terms of portfolio protection? What do you think investors do with their stock and bond portfolios?
It's very difficult at the moment. I mean, if we go back to last year, I think it was the worst year, or one of the worst years, for a 60-40 portfolio, 60% in stocks, 40% for your insurance in bonds. It's very difficult for asset allocators. Of course, as inflation's rising, it makes those bonds look less and less appetizing. They pay a fixed rate of income. And of course, stocks are going to struggle when companies aren't spending as much. They're starting to tighten their belts instead. So I think going forward, what you should see is bonds start to outperform. Maybe as we get into the latter part of next year, as the Federal Reserve start to make kind of dovish noises. I think for the moment, maybe a little bit early on that, but certainly as we go through next year, I think Treasuries could really outperform.
So place the bet: short, long term, medium term. What sort of debt are you looking at?
I think we should probably go across the spectrum, but maybe looking at the short end at the moment, I think there's more value there.